Vanakkam, Namaskar, and hello to all the viewers and listeners of this episode of Fixed Income Markets from Sundaram Mutual Fund. Indian fixed income market, month of June 24, has been a focal point for global investors. A landmark development was the inclusion of Indian sovereign bond, JP Morgan's Global Bond Index, which is expected to attract net inflows of similar to $25 billion to the financial year. This move coincides with a period of fiscal consolidation which has been well received by the market. The Reserve Bank of India record dividend payout of 2,15,000 crore has bolstered the government's financial position, providing a cushion against potential market volatility. High frequency indicators like spread correction, both direct and indirect, PMI numbers, credit growth, fuel consumption, steel consumption, cement production, etc., continue to be moderate to strong. RBI's financial stability report also paints a sanguine picture show of the financial system with low GNPAs and high capital adequacy ratio. Although some worry on the deposit growth has been evident, the minutes of MPC clearly show a divide between the external members on growth and inflation. External members, namely Professor Verma and Dr. Goel, think the real return is restrictive and can impinge on FY26 growth, while RBI members and Shashank Ghide want inflation to be durably addressed, particularly food inflation, as there is a favorable growth inflation dynamic. With food inflation remaining high due to inclement weather and low reservoir levels, good news is that monsoon has covered the entire nation and is likely to be higher than the long period average as predicted by IMD, restoring soil moisture, and that bodes well for the Kharif crop. On the global front, the divergence on the policy front is evident with ECB having embarked on the rate cut cycle, while US still not clear when the next move will happen. While Japan is looking for an opportune moment to raise rates, while China is looking to pump prime the economy by a combination of liquidity infusion and rate cuts. This divergence also highlights the polarized state of the globe, where the global trade has taken a backseat and smaller blocs are getting aligned together as per the geopolitical posture. In general, goods inflation has cooled off in developed countries, while services inflation remains a worry, and innovation and energy inflation is in a rate. Growth remains divergent with Europe, China facing subpar growth, while United States and Japan look better on that metric. Yields in the United States have risen by 20 basis points to 4.46% on account of probability of election of Trump for president after the first round of debate between Joe Biden and Donald Trump, as investors expect him to be more profligate with the expenditure and bring further tax cuts. Global liquidity is adequate as the pace of reduction of balance sheet has been slow, and some large central banks like Bank of Japan and PBOC continue to induce liquidity, while Federal Reserve has reduced its balance sheet similar to 19% from its peak. On the domestic side, liquidity has been dynamically managed by RBI through term money market operations, keeping it anchored to the repo rate of 6.5%. System liquidity was in deficit mode due to general elections where the spending was not happening. By now, with government formation, liquidity in the system is big on government spending picking up, as well as we expect the liquidity to further improve as the full budget is presented in late July with final allocation to ministry. While the immediate risk reward remains favorable for the short and mid-end, given relatively tight liquidity conditions, investors can gradually elongate maturities depending on their risk appetite and ability to absorb volatility in case of adverse market. Basically, what we call swap investors. Conservative and moderate investors can still benefit from elevated yields by positioning in the 2 to 4 year segment while awaiting rate cuts or liquidity easing that could lead to steepening. This will help capture both accrual and mark-to-market gain. Shorter term products like Sundaram Short Duration Fund, Sundaram Banking and PSC Fund, and Sundaram Corporate Bond Fund reduce volatility while improving the risk reward significantly for investors. In addition, 1A products such as Sundaram Low Duration remain highly attractive in this cycle. Thank you for your time. See you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.